Yeah. Uh, Good morning, students. This is Dr. Mohammad Sadiq Hassan, Head of Department Accountancy, and today we are going to study a topic called as buyback of shares. That is there in your semester 4 in AFM, that is Accountancy and Financial Management. So let us start now. To begin with the topic, as the heading says, it is buyback of shares. So buyback means the company is going to buy back their own equity shares. Remember, students, in this AFM, the FA Financial Accounting, we have two topics related to buyback. One is redemption of preference shares, and one is buyback of equity shares. So be very clear. When you're talking about redemption, it is redemption of preference shares, and when you're talking about buyback, it is buyback of equity shares. That's the uh, one clarification which you have to make it at the start. Now, let's come back to the introduction. What is buyback? It means buying back of company's own securities from the open market. Company will buy back like company decides ki whatever shares are there, let us buy back. So from the open market, company is going to buy their own securities. It is also known as stock repurchase. Definitely, this reduces the number of shares available to the general public because the company will buy back the shares. So company has the more number of shares with them, and the shares which are available to the in the open market is going to go uh, it will reduce. Okay, that's the meaning of buyback of shares. Now, let's come to the next part. That is, what is the effect of buyback? The first is there's a reduction in the capital of company because when there is excess capital with the company, what does the company do? Company decides, like, okay, let us use that money. If there is if there is no plan of company to uh, either to use money for expansion purpose or anything like that, then in that case, company can pay dividend also to the shareholders, as well as company can buy back some shares. So definitely the capital amount with the company will go down. Then definitely when the money is going to be paid by the company to the shareholder, there is an outflow of money from the company. So that's a second point effect on the cash flow with the company. The shareholders whose shares are bought back, like those who have given the shares back to the company, now they are no more the shareholders of the company. So these are a few effects of buyback of shares. Now the question is from where will the company get the money for buyback? Like what are the sources of buyback? First, if there is a the first option is fresh issue of shares. The company can go for fresh issue of equity shares to the like new shares will be issued to the public. From there, whatever money they will be getting, they'll be using it for the buyback purpose. Second, whatever free reserves are there, divisible profits are there in the form of general reserve profit and loss, they can use it for buyback purpose, and also security premium can be used as a medium of money to buy back the shares. Okay, so that's these are the effects and three effects and three sources of buyback. Now, what is the importance of buyback? Why do you think it is important? It leads to increase in the EPS. EPS stands for earning per share. See, when the company buybacks the shares, there will be a less number of shares in the market. Definitely, the earning per share will automatically go up because companies buying back those shares. Company will try to have more command on the number of shares. Promoters will have more command on the number of shares, and definitely they can decide the demand and supply of the shares. So that will lead to definitely increase in the earning per share of the company. When the buyback takes place, definitely the company share will always be on a higher side. Then second is it reduces the excess share capital of the company. Whatever extra share capital is there of the company can definitely be reduced, and that money can be taken used for buying back of shares. Then third is again there's some idle cash, whatever surplus cash is available can be used for the uh, buyback purpose. That money can be used instead of just keeping it idle. Let us buy back some of the shares. Let us keep it on our custody. Let us have a good amount of control over the company's number of shares. Definitely, who are the promoters of the company, if they buy back more number of shares, they have the more say in the company as compared to the shareholders. And definitely, investors are also are also at a win-win situation because they when the buyback takes place, it is always at a higher value. It is more than the market value. So definitely, they also paid more. So these are the importance of buyback. Now, buyback, there are certain conditions we need to follow when the company goes for buyback. First, it must be authorized by article of association. There's an article of association article in that it has to be mentioned, it has to be authorized. The company should go can go for buyback. Unless until it is authorized, you cannot go for that. Second important point is shares must be fully paid up. Means what any partly paid share, like out of suppose 10 rupees share, 7 rupees are being paid, 3 rupees is pending. So whatever share amount is still pending, that amount has to be cleared first. Only then the company can buy back the shares. So shares must be fully paid up. Company can buy back maximum 25% of issued share cap. 25% of the share capital only you can buy back. Okay, you can get it from the public. After buyback, the debt equity ratio should not exceed 2:1. Matlab here the debt should like maximum be double than the equity, not beyond that. Okay, it should not exceed beyond that. Okay, 2:1 is the if it is less, it is fine, but not beyond that. And buyback must be completed within the period of 1 year from its declaration. When you are going to declare the buyback, within 1 year, you need to know that it has to be implemented. Don't go beyond that. There are certain conditions and importance of buyback. Then the next point is what are the steps you need to follow when you go like to find the number of shares and how much shares I need to buy back and what is the offer price the company has to give to the shareholder. So for that, there are 5 steps you need to follow, which will help you to get the offer price. First step is own funds. Own funds we call it, proprietors fund we call it, owners fund we call it. So that's the first part we need to find out. The formula for that is share capital, which includes equity and preference both plus reserves and surplus, whatever is there in the form of free reserves. And then from that, when you add, and you're going to also subtract miscellaneous expenditures, which is on the asset side. So the total of addition and subtraction of the three will give you the first part that is own funds, owners fund or proprietors fund. Okay, this part is also uh, there in your management accounting chapter in the vertical balance sheet format. Then we have the second part that is borrowed funds, or we also call it as a loan funds. So how the funds are like taken from in case of borrowing from somebody else. It's our own funds, first part, borrowed funds, the second part, loan funds, debentures, or we have bank loan or term loan, whatever may be the case. That's part number two. Point three, how much amount maximum I can use for buyback. So there are a few things you need to keep in mind. 25% of own funds, whatever answer you get from the first step, of that 25% can be used amount. Second, it is own funds minus half of borrowed funds. Own funds from step number one minus half of the borrowed funds. That is half of second step. Whatever answer you get for that, that is a P1. And free reserves, that is general reserve, reserve from profit loss, as the case may be. You can use it. That is free reserve. Out of these three, whichever is less, that amount you can use it for buyback. And how many number of shares to buy back? It's very simple. 25% of total issued shares. Whatever issued equity shares are there, equity shares, of the 25% you can buy back. And then after getting step number four, the last step is how to find the offer price. For getting offer price, it is step number three, that is maximum amount of buyback, whatever is there, divided by maximum number of shares to buyback. That is step number three divided by step number four will give you your offer price at which the company will offer to the price which the company offers to buy back from the shareholders. Okay, fine. These are the 5 steps. I'm going slow, like to know different parameters how to get the uh, offer prices and number of shares to buy back. Now comes journal entries. So there are approximately maximum seven to eight, because in the first step there are two entries. So approximately 7 to 8 journal entries are there in this chapter. Starting with first is if there is any share which is not still fully paid up, then you have to make that partly paid shares into fully paid up. There are two journal entries for that. Then you can have fresh issue of shares, sale of assets, amount due on buyback, what we need to pay to the uh, shareholders. Then creating of CR, that is capital redemption reserve out of divisible profits. Then whatever premium on buyback is there, that needs to be adjusted, that entry. And then when everything is done, you can go for a final payment of buyback amount. So these are the maximum seven entries and or 8 entries, whatever may be the case, if there is a first to entry bifurcation. Okay. So let's go and see every entry step by step. First part is let's assume it's a partly paid share case. So making partly paid shares as fully paid up means suppose out of 10 rupees share, 7 rupees has been paid, so 3 rupees is pending, whatever may be the case. So we need to call to that respective shareholder by your final call money is due. So that is the entry for making final call money due. So the entry is final call money account debit to equity share capital account. You're going to first call that particular person whoever amount is pending, and you will get the amount. So that's the first part, final call money due, and then you will get the money refunded. When you go for buyback, it is assumed paisa aega, you're going to get the money, no need to worry. But we need to convert into NT at the same time. So when you are going to receive final call money due, you are receiving money bank account debit to final call money account. So these are the two entries in the first scenario when the partly paid shares are still pending. Fine, students. That is final call due, final call money received. Then coming to fresh issue of shares. When the company goes for fresh issue of shares to new equity shareholders, it is usually at a premium. So in that case, suppose 10 rupees share, you are issuing at 12 rupees. So 2 rupees is the extra money what you're getting. That is supposed to be security premium amount. So the entry will be you're receiving money, bank account debit, you're issuing shares, debit what comes in, credit what goes out. So you're giving equity shares to equity share capital account, and then the extra money what you're getting, that is called a security premium. That is a profit for you. So credit all income and gains. Easy. Then let's come to the next entry. When you're selling off, there may be some entries where like sale of assets or investment. Although they are not part of, they are not used for using it for a buyback, but can be a part of your journal entry. So when you're selling an asset or investment, so you're receiving money. So these have combined entry. Like when you sell an asset, if there is a loss, then what is the entry? If there is profit, what is an entry? Instead of making it two separate entry, I have clubbed in one. But in the exam, whatever as per the transaction, you have to pass the entry. Now suppose you're selling the assets, so you're receiving money, debit what comes in. If you're having a loss, you're selling, if there's a loss, like out of 2 lakh machinery was there, asset was there, you have sold at 1 lakh 80, 20,000 ka loss hua. So in that case, profit and loss account debit 20,000. If it is a that scenario, and then you are selling the asset or whatever assets are going out, credit what goes out. So if it is a loss entry, it is only bank debit, PNL account debit to asset or investment account. If it is a reverse case, you are selling at a profit, means 2 lakh ka asset you are selling at 2 lakh 50. Example, you are getting a profit of 50,000. In that case, what is the entry? Bank account debit to asset account, whatever price, whatever profit margin you are going to get, you're going to credit with the word called as profit and loss. See, profit and loss is to be used for both. If it is loss, also we use profit and loss, but it has to be debited. And if it is a profit case, you're going to credit profit and loss. So if it is like I give an example, 2 lakh asset you are selling at 2 lakh 50. So you're going to pass the entry like bank account debit 250, to asset account 2 lakh, to profit and loss 50. Are you getting me? Then in that case, there will not be loss entry. Either of you will be getting either loss part or profit. As the case may be, you have to keep on changing. If it is loss, P&L account will be debited. If it is profit, it is going to be credited. Okay. Then you can take the amount shares from the equity shareholders which you need to buy back. Whatever amount you on buyback, we have to pass entry for that. So equity share you're going to take, so debit what comes in. Definitely, when you're going to buyback, I said you when your buyback takes place, it is always at a higher value. It's higher than the market price. So that extra amount what you're going to pay to the shareholder to induce them to give it shares to you, then that is a loss for the company. So that is debited with the word called as premium on buyback because debit all expenses and losses. And both the amount of face value and premium amount has to be paid back to equity shareholder. Equity shareholder becomes your creditor. So you're going to credit that. Or you may say he's a giver of, in that case, credit the giver, whatever may be the case. So debit what comes in, debit all expenses and losses, and uh, giver is equity shareholder. He has given the shares to you, or he's a creditor also because you have to pay to him. In either of the case, that person name will come on the credit side. So this is entry number 4 for you. I hope so it is clear till here. Now we come to the remaining entries. Now, after that, the you when you have one for fresh issue, then you have to also see, you have to whatever profits reserves you are using, that amount has to be transferred to CR, that is capital redemption reserves. That is the entry. Whenever you are going to use some part of divisible profit, that amount needs to be transferred to CRR. So accordingly, when you are using profits, profit is a credit balance. It comes on the liability side because it has to be paid back to the partner. When you're using any kind of a divisible profits, it has to be debited. So general reserve or PNL or security premium account debit, and that money you're transferring it to CRR, stands for capital redemption reserve. So it is प्रॉफिट को आपको ट्रांसफर करना है, सो इट इज गोइंग टू चेंज द साइड, क्रेडिट से डेबिट हो जाएगा बिकॉज यू वांट टू रिड्यूस इट, सो इट हैज टू बी डेबिटेड, एंड वेर यू गोइंग टू ट्रांसफर दैट अमाउंट, that name should be credited, that is to CRR account. Okay, after going for fresh issue, after using your profits and all, then you have to also see the premium part, whatever extra amount you are supposed to pay to the uh, equity shareholder in the form of premium. That amount has to be adjusted, that has to be adjusted. So in that case, in the previous case, it was debited when the premium was, if you just see the previous part, in this case, the premium on buyback amount was debited. Now you have to adjust, you want to write it off. So it is going to change the side, it is going to come on the credit side. You want to write it off. That's why it is credited here. And that premium amount we have to adjust. So the first priority is always security premium. When it is there is ample amount available, you have to just use that accordingly, make it. If not, then you can take some part of other profit and loss and reserve to uh, write off your premium on buyback. So what will be the entry for that? Security premium or profit and loss or general reserve, as the case may be. That will be debited, and premium which was debited first, now you are going to write it off. You want to adjust it, you want to settle it, so it is going to be coming on the credit side. So once the premium part is also done, then definitely you are ready with your final payment. You are going to make the final payment to the equity shareholders. So they are the receiver of money, debit the receiver, and from your side money is going out, credit what goes out. So these are the 7 entries which has to be kept in mind. Am I very clear with this, students? Fine. And then what we have seen the steps of buyback to get the offer price. We have seen 7 to 8 journal entries. And suppose if at the end they may ask you to prepare a small extract of balance sheet where you have to just show what is the effect of buyback on few things like share capital. When definitely when the company takes back the shares from the public, the share capital will automatically go down. So you will have a reduction in the share capital that you have to just show if it is asked. Then reserve and surplus, whatever reserve and surplus company uses for buyback, that also goes down because you are using reserves. So reserve balance also goes up, and simultaneously the CRR creation, what you have created, that will go up. Same way bank balance, as the case may be. If you have sold any asset, you have received money, so bank balance will go up, and whatever payment you make to the shareholder, that reduces your bank balance. So accordingly, you will be having the effect. And at the end, asset investment, whatever may be the case, you're selling, so it goes down in that case. Okay, this was the full short summary of my topic related to buyback. Well, I'll just go once again. I'll just share with you what we have seen. We'll just go once in a time. Let's go once again. What we have seen here, I'll just run through once again for you. Uh, what is buyback meaning? First part, you can see that. So I just make it very clear, students. Buyback is for equity shares, not for preference shares. Preference shares के लिए we have redemption of preference shares. So what is buyback? I showed you the introduction part. What do you mean by buyback? Then I have given you what are the effects of buyback and what are the sources which will help us to fund the buyback of shares. Then we have seen importance of buyback. What are the conditions of a buyback which has to be followed? Then like how to find the number of shares what I need to buy back, as well as how a company can go for, decide its offer price. What are the steps you need to follow to get the offer price? Then what are the journal entries which we need to keep in mind, because journal entries are very important here. There are 7 to 8 journal entries here. starting from partly paid to fully paid. There are two entries for that. First is a final call money due and final call money received. Then comes when you're going to go for fresh issue at premium. Then whatever sale of asset or investment at profit or loss. Then whatever amount you need to pay to the uh, equity shareholder with premium. Then creating of CRR out of divisible profit, transferring that amount to CRR. Then whatever premium on buyback amount that needs to be written off, that needs to be adjusted through this profits part, premium, and then finally whatever payment you make to buy equity shareholders, final payment, and then the extract of balance sheet, effect of buyback on share capital will go down, reserve and surplus will go down, CRR will go up, bank balance will accordingly change, and then assets will go down if it is. So I hope so. This was the uh, small PPT which I had shared with you for uh, giving you some glimpse of buyback. I hope so. Things have been clear. For any query, for any doubts, you can meet me. I'll help you. Thank you, students.